Hey, greetings, and thank you so much for joining us. This is Macro to Micro Options Power Hour. I'm Samantha LaDuc, founder of LaDucTrading.com, joined by West Coast. I'm East Coast. We've got Hans Albrecht, who is very graciously joining us on these Wednesdays to do a public-facing webinar to talk market, how to trade it with options, a little bit of sector rotation that we both see, and then how to size up some particular option plays on stocks of interest. We also then kind of pivot into what's going on with market plumbing, what we see, of course, going into OPEX this Friday, as well as election and end of year. So we kind of look at positioning, quant, and the like as it relates to the options market. And then last but not least, we take your questions. So Q&A, you can hit us up, Zoom Q&A, feel free. We make these available for clients every single day of LaDuc Trading. Hans is not just a former market maker, but also portfolio manager, and he shares his trades inside our Slack member workspace for Club and Edge clients. He also does his own course program, which is extremely effective, which is one of the reasons why I wanted to partner with him, so that our clients could have the benefit of some greatly reduced course program tuition fees, but also so they could really up their game and use advanced options. I like to use them, although I'm mostly a directional trader. I have a fabulous contributor for 5 years, Archna, who is very much focused on advanced options. But teaching that to folks, it's not necessarily second nature, and it does take a really good mentor who can synthesize and distill all of these years of trading and options knowledge so that people don't hurt themselves and that they know how to manage risk. So I'm very happy to introduce Hans in this webinar series every Wednesday at 4 o'clock. Come back, use the same access link. We'll do it again next Wednesday. All right, Hans, I'm going to throw it over to you on this Wednesday afternoon, as we are now into earnings season officially since last week, banks kicking off, and VIX expiration this morning with a big shake and bake yesterday in the market, which we talked about with ASML. In fact, we had just sized up a Nvidia financed call spread for clients early last week, and this is gyration, if you will, into earnings and election and year end. Oh my, where are we at today? How are you seeing the market?
Yeah, well, I mean, this is the Energizer Bunny market, isn't it? I mean, it doesn't like a sell-off. It doesn't like to bounce back from, that's for sure. Now the Nasdaq, not quite as much, and we'll talk about that in a moment when we talk about a couple of hedge ideas. So it's definitely this broadening out that we're seeing, and our little friends, the small caps, are actually starting to run, despite the fact that I saw something yesterday that talked about how even a larger portion of the Russell 2000 is in negative earnings territory and struggling. So, lower rates.
43% of the Russell components are unprofitable. They are helped by years of ZERP and fiscal and basically policy intervention. But yes, you're right. They have been suppressed. And now, what do you see with that?
Yeah, bouncing back a little bit. We saw that big sort of rush to get in. We saw upside call skew actually extremely steep. You almost never see that in an index where the calls are more expensive than the puts, relatively speaking. And we saw that a few months ago. So there was that initial rush into small caps. Then that completely reversed and failed, not to the extent that we got into the 190s again on the IWM, but we managed to bounce back. And now we're actually starting to push those highs that we saw in that period. And so I think that's a little bit interesting. Of course, our other broad market, larger, mid and large cap names have been doing okay as well. And the ASML news just didn't help that sector, did it? Although it's not hurting our Nvidia, which is, I was sort of wondering, I posted something this morning talking about how, we're starting to see a little bit of dispersion within that sector. So, when there's a new craze, all boats are floated, right? Because all this money's coming in, and people will sort of buy literally anything, better quality, lower quality names. As long as they're involved in AI, they will buy it. Now we're maybe going to start to sort of get a little bit more choosy and distinguish between, I don't know if you see it this way, there's almost a distinction between the secular trend of like an Nvidia and an AMD versus a kind of almost cyclical trend that maybe ASML or a Micron might be part of. So now maybe these are sort of, we're seeing a separation of these two worlds here, which in a way might drive more money into those few winners like an Nvidia. And I wonder if maybe that's what we're seeing today with that nice bounce back in Nvidia.
Well, I'm showing this chart right now, which is to say this is the AI data center value chain. And you can see down here, manufacturing equipment maker ASML with CLAC, with Lam Research, with Applied Material were slammed. But they have actually been in massive distribution since July. So they're more of a bellwether also on the end, for the technology stack, not just what inside the rack versus the packaging and of components and electronic components, manufacturing, networking, power, right? The power distribution players that have been hot fire flames still that are part of the utilities space. But this is definitely where we're seeing falling demand. And that's exactly what happened with ASML yesterday. They showed a 50% surprise guidance, right? In their
Big surprise. Yeah,
big
huge
surprise.
surprise.
And that hurt the whole semi space, but you can also see Micron popped right back up like a daisy. Nvidia is right back at my 136. AMD is suffering for some other reasons, but the point at Marvell, beautiful. We set that up as a breakout trade. So not all semi is committed, created equal. So that sector though of manufacturing equipment all got taken to the wood shop.
Yeah, definitely. And so
Shed.
now people are
My idioms.
the woodshed, yeah, the wood shop maybe. Will we need to retool our view of what names we want to own within that sector? So do you still like your 270 level on the SMH? Does that sort of change
I
any
do.
of your
No,
view
nothing
there?
has changed. I'm still weirdly, strangely convicted still, right? So I had this thesis after you ran my trading room when I was gone in August, and August 5th, which was the reflexive bounce, and you're like, I can still see 6,000. You saw that then. I can still see 272 SMH. So we
All
have
right.
to go with what we are convinced of until we really have a clear indication that that's going to change. And I think because Nvidia was the first to kind of lead this rally much higher, and now we do have a lot of retracement in SMCI, right? All of their 2024 gains are wiped out. ASML, all of their 2024 gains are wiped out. They are kind of falling one by one, but they're in totally separate, for different reasons. So I think this is going to be a while before we actually get into weakness for Nvidia. That's next year. That's definitely a thesis of mine for next year, but not this year.
Any chance we start to focus a little bit more on software rather than, maybe
Oh,
the
that's
nuts
been
and bolts?
gorgeous. So
Yeah.
Archna, someone who's worked with me for many, many years, was a client and now contributor for 5 years. She's active in these client Slack huddles that we do, right, for our options review. She is one who spots the moves very early as well with sector, specifically for momentum plays, right? So she's really excited about trading software. And so she watches that very closely. It's in a really nice move higher. So there has been this kind of, I don't want to call it diffusion, but the concentration risk of MAG 7, which has been the rage until that July, right, de-risking on the yen carry trade into the August 5th reflexive bounce. Now it's widening out, not just small cap, specifically value within that small cap rotation. Like I track that. It's not just, it's
Yeah.
the IWN is outperforming far better than even the IWM. So the point is the IGV sector rotation, it looks like it wants to continue this year as well. So yeah, you got anything in there that you're trading specifically?
In that sector, in the
IGV?
IWM, IGV.
No, IGV or IWM, since both of them are kind of starting to broaden out and give us some hope.
Not in particular, but I'm looking at some, I'm trading a few things like, I think SOFI is kind of interesting. I'm looking at a few of these kind of almost cult meme type stocks, smaller names, smaller companies. And they're starting to really react a little bit. And so I'm looking for that potential gamma squeeze in some of those smaller names that have really been kind of almost under the radar for a little while, yet talked about so much in social media, but it hasn't really translated into great performance. And SoFi is one of those names which kind of has really caught my eye. We did a risk reversal on that. and did extremely well on it, but I'm looking to put something else on. But I liked your earlier point about the sector rotation, and I love how you really focus on that, because I think it's sort of a pro hack for everyone listening out there, is really to pay attention to those sectors and those themes, those like an SMH. Look at those broader proxies for different areas and themes, because you can really see when something starts to rotate. Don't keep pushing that boulder up a hill. If for example, semiconductors are out of favor and people are rotating their money into something else, don't keep pushing against that. Try to recognize what's actually starting to move again, what's starting to outperform. And it's easy to do on stock charts. You just go, you go SMH SPY, and then you get to see, well, how's the SMH working versus SPY?
You're doing ratio analysis, which I love to do, for sure. But it's also just kind of sizing up. Like I put an ETF sector list together. It has all of my favorites, and some of them are redundant. But the point is, I get to see what's leading in a particular day. You just mentioned, for example, IGV. This is that August 5th reversal of size. And it's broken out, right, very firmly. And this isn't any longer cap weighted heavy in Microsoft. It's actually, starting to include some of the other components. And then we basically go in and kind of see the ones that are performing the best at the time to see if there's some more juice in that lemon to squeeze kind of thing. So there is a lot of oversold plays in the IGV space that have come up from the bottom, like really DocuSign. Like who cares about this one? Well, we sized this up, and sure enough, we talked about this a few weeks ago, right? I said, what do you think about this? Looks like a bottom fishing play. It's in the IGV space. Microsoft isn't going anywhere fast, really, right? It's in distribution.
They put it in the 400 as well, which is that extra little boost.
And then they put it in, but they didn't put it in until right here this day.
Yeah, so, someone knew. Knew.
So there are a lot of those types of plays. But again, I'm doing their live trading room, right? So I'm looking to see, okay, what's leading today? Uranium, already have that. That's, CCJ, that's URA. I mean, this is hot fire flames. And I might add, you did a fabulous put reversal on MSTR recently, because we were both bullish Bitcoin. You manifested that with a MSTR trade. And then you were expecting, it got a little ahead of its skis, and you put on a 2-for-1 ratio, a put spread. And you got to talk about that, because this is a little bit of where we're at with CCJ. So CCJ is America's #1 uranium miner. This has been a trend long recommended since 2020. I've written a lot about this. I happen to be very fortunate that in the uranium space, I had a client for many, many, many years who was an absolute expert in this and co-founded the #1 uranium newsletter on the market. So he was one that really kind of pushed this theme in 2020. Long story short, I warned clients right here, literally, because see this line? It goes back to June of 2007. It was the high. And so I said, believe it or not, markets have a memory. This is resistance until it isn't. So we did come all the way back down, formed a double bottom. China helped, of course. But in general, commodities have been hot fire flames, and uranium in particular, because of nuclear energy making a resurgence, Microsoft investing in 3 Mile Island. Amazon came out this morning saying, yeah, they're going to get involved in SMR, which is these smaller nuclear So long story short, you've got CCJ right back up to 2007 highs, where I warned, and you know what happens once it gets above, it's blue skies. So how would you like seeing this strength? You can't really appreciate it so much, but this literally bottomed on August 5th, made a double bottom, and then boom, all of September and October, we literally are right back up. And I know this wasn't one that you were planning to answer, but it's the same kind of thing with MSTR, right? Beautiful advance, all kinds of good reasons. Now, how do you trade this extended play?
Well, I like that. I mean, I'd like it to break through a little bit first, just to make sure we don't get this double top forming here. So, maybe a little bit of a pullback and then a bit of stabilization, kind of like we've seen in Bitcoin recently, kind of pulled back, but you were talking about how it's sort of stabilizing a little bit and, trying to shape up towards another push higher. So, this has had a pretty good run already. And, I got into some uranium, actual uranium, a holder a few weeks ago thinking this would continue, but I didn't get into CCJ. I thought I missed the boat on it and it kept going. But on something like CCJ, I would look for, signs that it's going to push through. I do like, one thing is you want to have a good story behind you, right? You want that narrative to be very, very strong. And I don't think this is waning at all. If anything, the big cap, I mean, we've been talking about CapEx forever. And, big cap is keeping this whole AI game going and making sure Nvidia has its pockets full of cash. And so, once they start getting involved, I think that can be something very durable. The whole nuclear power play, we've seen the whole power up theme really, really push ahead with stocks like VST and things like, former kind of boring utilities suddenly in a growth and utility kind of hybrid world. And I think the power up play is here to stay. And I think this is a very, very important part of that play, even though we've had some good runs already. I'd prefer to see a little consolidation, but I think there's a way. I think it's something that you can almost consider almost the beginnings of something almost more secular in a way, in terms of its prominence within the power area. And people hadn't really thought of it until fairly recently, in terms of that kind of ability to power this whole AI thirst for power. I'm looking at something like CCJ right now. I'm looking at the upside skew, and it's actually very, very steep, which to me is telling me people are reaching for those upside calls. They're starting to get worried about missing that upside. And to me, in the old days as a pro, I would look at that and I would say, I'm going to fade that a little bit. But I feel like upside skew is actually something to be very, very respectful of these days. We've seen it in the GameStops, the AMCs, and plays, that's a good sign that there may be a squeeze being initiated. Now, a squeeze isn't necessarily going to be initiated in something like CCJ, but upside skew is a sign that people are getting in, they're excited. And so call spreads can really work for that. The vol's kind of high. So your choice is either a call spread to the upside. So you're buying a call a bit closer to where the stock is trading. You're selling one further away, but you're getting that nice, more expensive skew to the upside. So that really works with the call spread. Now, if you're
by
not,
the way, just
sorry,
real quick, I'm still showing my CCJ chart. Can you see down here? This is basically option flow for the day. It's just showing a November 55 by 60 likely call spread. So right at 55 up to 60 as a way to take advantage of if there is forward motion. I still think this is a likely place for it to digest.
Yeah, that's what I'd be hoping for, a bit of that. I don't want it to go to continue. I'd want it to digest a little bit, and then maybe even let some of this excitement die down a little bit, so that maybe the structure gets a little bit less expensive at some point, and we kind of ramp up for that next leg up. So this is one where I'd like to see a consolidation before the next leg up, but I do feel very good about there being another leg up. And so you can do it with the call spread. You can structure maybe an upside broken wing butterfly because vol is very high. So if you're not super convicted that it's going to happen now, but you're worried that it might, butterfly might be the better way to play something like that.
Okay, and then let's talk about your MSTR, where you did see this, right? We were both talking about how we were Bitcoin bullish, and I'll show that chart again. And MSTR typically leads, at least with my experiences, MSTR leads even before Bitcoin takes off. Coin usually is the best surrogate to use short when Bitcoin rolls over. There are others, I know, and some play, pure play Bitcoin and Ethereum. But the point is, it literally ran into this resistance. We were talking about this before it had run into this resistance, which fascinating. It happens to come from a 2020 level before they, this is my line that I put on 2 years ago. It's hard to explain my system. Just work with me. So it serves as resistance because as you have mentioned, I work from different time zones, right? I'm really into time frame congruence. This is the hourly, right, for chases. This is the day for swings. This is the week for trends. And then I even go out to monthly, and this is where it was going to hit its head, period. Just like the CCJ, when I warned, careful, this is a 2007 high. It has a memory. It has to get and stay above that before it's safe. Expect it to pull back. So if you're long, protect. So this is when you put on your put ratio spread. Talk about that a little bit, because I thought that was brilliant.
Yeah,
Okay,
so this is kind of in keeping with your theme of you talked about, there's more juice in the lemon to squeeze. And
yes.
sometimes, sometimes that lemon has a little more juice in it, but there's almost a parallel lemon, right? So that's one of the nice things about being aware of what the other names within a sector. MSTR had this really big run, and I started to look around and say, well, what hasn't really participated yet? So then I started looking at some of the Bitcoin miners, and they've got their own problems. And we've done really well on a couple of CLSK risk reversals. So I've been involved in those a little bit, but those companies tend to issue a lot of stock. They have a ton of debt. They're kind of like miners in the gold miner, and it's in the precious metals area. They really have this tendency to screw things up. So I'm not a huge fan of getting into the miners all the time, but I thought, well, what about coins? So I'm going to show you.
One pitch for Mara. Mara is really the better
Yes. Okay. I
okay.
like that. Fair enough. I had a question actually from a member today about Mara. And I said, the Mara tends to have a pretty good beta. It can really get going. So that's, one of the ones I don't mind. CLSK, I don't mind. A little bit higher institutional ownership, but you really have to kind of know which miner you're trading. So I prefer to kind of get into the bigger proxies, the MSTR, which is probably the best one. But the problem is it sort of went. So we had Bitcoin kind of coiling here when I originally put this trade on. And so I had a nice pass MSTR. I think the trade made 220% or something, and it could have made 400. So I was irritated with 220%, which was kind of funny, but it kept going. And then this is what happened. Here's your MSTR versus Bitcoin. Look at this outperformance that we had here. It just went sort of bananas to the upside, and then consolidated. And I was looking last Friday, I was looking at these charts, and I said, and originally I suggested an upside financed call spread in MSTR. And I said, well, hold on a sec. I put it in the chat and I said, wait a minute, there might be a better play on this. And I looked at coin. And so here's your coin versus Bitcoin. So while MSTR was going crazy to the upside, we had coin really lagging behind. It was down in here. And I thought, well, this might be the better play to take. And so what we did is we put on the coin risk reversal. So this is in the chat on Monday. I said, I'm adding the coin
Yep.
Sell of the June 2025 150 put and adding the 200 310 call spread for even money. So you could sell the put and buy the call spread for nothing, right? You get it
And
for
we talked
free.
about this Tuesday as well. So this has just been banging it out every day.
And
This
it's
is
going
awesome.
and the amazing thing is, Samantha, the MSTR has actually pulled back from that 220 down to almost 190-ish, 191. And I've got the free puts there that I'm going to tell you about in a moment. But I
Yes.
thought, okay, let's get in here. Here's our risk, actually our CLSK, just to show you that I'm not, I'll trade other things too. That's a Bitcoin miner. We got in for 9 cents. And I took half of it off at 140. I think it's up to 165 on the other half today. So structure was selling the 7 put to get into the 9-11 call spread. It's a very similar structure.
Love those.
And then what I started to see was that this coin skew was really steepening. So remember a moment ago, I said, it's interesting. Once you start to see things suddenly steepen, that to me is a sign that there's probably flow coming in, buying that upside, and then market makers are selling and then having to hedge with stock. And that can kind of create this sort of positive feedback loop and things start to move to the upside because of it. And so I thought, well, MSTR had its run. Let's put the coin on. And by the end of Monday, it was up 4%. I think it's up 9% now because it's just kept going. So sometimes, you want to kind of look at where's the juice left within a trade. And that's where this sort of the trades that we were talking about earlier, looking at the ratio can really be quite powerful in finding something that looks interesting.
So when do you take the coin off? Because right now it's hitting its head on I'm going to show mine real quick, just because we talked about this. Bitcoin looks ready. I also have a colleague who studies on-chain, and you trade it. I don't even believe in it. Doesn't matter. The point is you get so many vehicles and it's very viable to trade. It's fun. So anyway, the point is, I don't, as I mentioned, crazy go after this stuff, but very clear this kind of 212 was target, right, for this kind of coin advance. It happened very quickly. Like you said, MSTR kind of softened at that resistance level and then coin took off. MSTR also had a very large NAV differential. Lynn Alden was talking about that. So one of the reasons it extended from the underlying, so much of it is based on the underlying, etc. Coin doesn't have any of that. It really
That's
is
true.
about transactions
Yeah.
and sentiment. So here we are at 212.22, which just happens to be a level of support and resistance on a weekly, since we're talking about time frame congruence. It is, however, above the 200-day. That's better to be above than below. So now what do you do with your coin if you are expecting some consolidation here?
Okay, so it's never bad to take some profits, especially when you get them quickly like this. So I would suggest you take maybe half off on a position like this. Now, one reason I feel comfortable with these is that I don't have an outlay of cash, right? So if I buy a call spread and I've spent $3 to potentially make $7, I have this sense of urgency, as to when I'm going to monetize, because I know I have $3 on the line. I don't want to give back what I've made and then lose the $3. So when your overall long premium, or you've spent money on overall net premium, you kind of have this sort of heightened sense of urgency to really make it work for you quickly. Now, because I haven't spent anything on this, worst case scenario, it goes back to where it was, and I've certainly given up a nice gain, but it's kind of hard to describe, but it sort of gives me this sort of sleep at night ability to kind of wait it out. And if I have conviction, I kind of feel like it maybe could get sort of towards that 250 level. And then, of course, if Bitcoin breaks through 70, I think you would agree that all bets are off. I mean, everything just kind of is in play again. So I kind of feel like maybe you could take off about a third here, look for that 240 to 250 level for the other third, and then the rest is just gravy. You just let the rest run.
What month are you using again?
I'm using June of 2025. So this is a longer term play.
Oh,
Yeah.
okay, so you definitely have time on your option. Excellent. Now,
Yeah.
Archna did an advanced option. She posted in her Slack channel for clients, and it was a 190, 205, 220 call butterfly. A few weeks ago was almost gone, right? So coin didn't move, it didn't work. And then this past 2 weeks, she's up 350%. So I don't know, Archna,
Wow.
what month did you use? I'm just kind of curious. October, November, December. I don't remember. But in any case, that's the type of recovery in a butterfly if you're patient enough as well, right? You kind of set it.
Yeah.
Oh yeah, so that was
Yeah.
short duration.
This Friday. So you were under the gun,
Friday.
Arch. Now that was a nice one. But you know what? Sometimes that just happens. You kind of have these positions, as an options market maker, I had that all the time. I'd be sitting on, 500 puts that I thought were completely worthless. And then boom, one day they kick in. That's the greatest feeling in the world when you have something worth nothing. It turns
Sometimes
into
it's
gold.
lucky. Sometimes it's better to be lucky than good. But
Yeah.
the point
But
is, it shows very different styles, very short duration, right? To June. But
yeah. But you put
anyway,
yourself in you put yourself in good positions. Kind of like Lee Trevino, the golfer, used to say. He used to say, the more I practice, the luckier I get, right? And
yes.
I think he's sort of,
Oh my
tongue in
God.
cheek saying, well, there's something to it. Keep putting yourself in good positions to win tournaments, and you're going to win a few once in a while. So, I love those trades. And speaking of cheap trades that can really kick in, I wanted to talk about the MSTR. So on the original MSTR trade, I made my money. We got to this trend line, which is why I got out, right? I didn't see it kind of continuing to break out and really outperform, particularly versus NAV, which, I guess MSTR can do because it's that kind of stock. But so it got to here and I bought the 176 put and sold 2 of the 162 puts for about a 60-cent credit. So that's called a ratio spread.
Yep.
It's
Okay,
called
sold 2, bought 1.
yeah, exactly. It's called a friend spread technically, but basically what you're looking for is you're looking for there are different ways to win here. You can either set it up so that your break even is about twice the distance between the strikes. So worst case scenario, I would have owned MSTR at 147, which is right around this 50-day. So I thought, okay, that's not bad because the low on this thing was 120-ish. I can own it there, and if it starts to get worse, I can panic. But worst case scenario, I own this thing at a reasonable price. If it trades between 176 and 147, I'm going to make money everywhere in there, the most around 162. But the way I love to trade these things when I put them on is I love them to move away from the entire structure. And that's actually what this did. So it kept going up. And I said, okay, that's fine. Because what happens is when it keeps going up, your puts that you're short completely collapse. And so eventually what I did when it was around 190 is I bought those puts back for 50 cents. And what that left me with is a free set of puts at 176. So the puts I was short financed the put I was long. So now I'm sitting on this 176 put. And when MSTR was at 225, it looked pretty useless, but it traded down to 191 the other day. They were actually worth 250 at one point. And I thought, boy, I could just sell these for 250 and turn that into a win. But the way that I look at it is I have this free protection in a sense versus my coin. I know there are two different things in a way, but if that sector collapses, those puts are going to make up for some of what I'm going to give back in coin. So for me, they kind of work together as a pair at this point. Now they're going to go away in a week, and there's a very good chance they'll be worthless, but they're going to sort of serve a purpose. And like that fly that Archna had, you never know. Once in a while, crazy stuff happens, and suddenly, a put that was worth nothing is worth 20 bucks. And that's really, really fun when it happens.
That's a lot of fun. Okay, so what if this kind of comes back to your trend line? Now, granted, this is a ratio between MSTR and coin, and then it decides to bounce and move higher.
Well, my market maker self is going to say, well, look, if we can get back into that 177, 178 range, it's got to happen pretty quickly. I could buy stock against those puts, and I could turn some of them into what we call a synthetic call. So it's basically a straddle. I could turn this into a straddle where it's going to make money on the way up. It's going to make money on the way down. We call that gamma delta hedging. We're going to go delta neutral there and turn this into a play that can go either way. So I'd like to see it around 179.80. I won't sell those puts out. Maybe I'll even just kind of buy some stock against them. And then I sort of have a bit of a free shot to the upside again. So you can play it a few different ways. You can either get rid of them because time's running out, or you can turn it into a kind of straddle with some synthetic calls. So there's lots of fun to be had in this sector, which makes it really, really fun.
And it's probably going to last a few months. So
Exactly.
there'll be more discussion on this.
Exactly. So here's your coin chart. See, it kind of started to move. And then this is when we put the trade on in the community. I've got a Slack channel with LaDuc. So I shout out my trades and my ideas and crazy thoughts all the time. But this is where we actually rallied on Monday morning. I think we hit maybe 187, 88. And I thought, okay, well, maybe the horse is out of the barn here, but it pulled all the way back to 179. We had a little bit of a pullback after the open, and then boom, that was it. It took off. But look, this sector's not for the faint of heart, right? It is what it is.
No, it's not. And the same thing with gold and silver. We talked about that. I know we want to get into some Netflix earnings, Q downside hedges, Tesla, because we're still waiting for Tesla to do something totally wicked awesome, right? But
Yeah.
we do have gold and silver bugs amongst us. And in particular, the commodity space has been very strong. Any comments you want to put? I in fact just posted a finance call spread on GLD into November, given lots of different things that are kind of transpiring with BRICS and the dollar and some other things, but basically it's still all-time highs and it's pushing higher. So anything that you wanted to show or kind of color on gold or silver, then we'll move on.
Well, and again, Samantha, this is an area where you've got vol levels high everywhere, right? So option pricing's high. We can see cross-asset volatility, and gold is in the yellow here. So fairly high as well. Not too high compared to a couple levels we've reached this year, which is actually kind of interesting because we've got equity vol very, very high. We've got rates vol kind of through the roof. Which I'm sort of looking at TLT for some interesting plays. I had that back spread that we talked about a couple of weeks ago. It absolutely killed it. But now that play is done and the vol's very high, right? So you have this whole, and option traders really need to understand that you can be in one regime and move into another. And that requires a whole set of different kinds of structures. Because, and I had a client the other day say, well, I was long these BABA puts and the stock went down 10 bucks and I didn't make any money. And I said, yeah, that's volatility, right? The volatility collapsed. So we're in this regime where it's spreads, it's butterflies, it's ways that you can kind of alleviate some of the high cost of those options. So right now, gold is a little bit high. it's going to really come down to how you feel, I guess, about the dollar, how you feel about the chart on gold. What are you thinking on the chart here?
It's ironic because I literally have been posting on this, as you know, for ever. And GLD is right up to just about a price target that I have given for a while of 250 here, Lil.
Wow, it's looking good again. It's popped right back up. So we came down to almost 241, and we're almost at all-time highs, are we?
Yeah,
Wow.
so this is one that I have to really credit. Craig was very bullish for all kinds of reasons about, you know, China central bank demand, and basically there's a lot of trade settlement that's going on outside of the dollar. So long story short, it has been a very strong theme since November, December of last year. Jeffrey came in, who's, as you know, our economics advisor, but for those who do not know, he's really classical economics and brilliant as it relates to bonds and precious metals. I mean, and China. Oh my God. So long story short, this March 1st, when gold started spiking higher, it was a regime change. It was just no question about it. We're going higher in gold. So this is multi-month, although you can see this, right? If you look at the weekly, lots and lots of digestion around that 224, and then price target was 249, 250. Let's just call it 250, right? Whether it's on a daily, whether it's on a weekly, and I go over gold and silver every single bloody day in my live trading room. But the point is, we're almost there. So the reason why I bring this up is I literally just posted this for clients saying, hey, by the way, even though we're almost up to that 250, look what I saw just come in November 29th, 18,000 contracts of what I consider to be a really nice looking financed call spread, right? Can you read this? They're
Yeah,
selling
very
the
nice.
240 puts and they're buying the 255 by 270. Mwah, I love that. So the point is the one big reason gold will not do well is if we were to have peace, seriously, in Ukraine or the Middle East. Think about that.
Yeah, yeah,
But that's not that. In other words, there are lots of reasons to buy gold, but the point is that is one reason to sell gold. Is peace is very good, but it is not going to be bullish gold. So I'm just trying to like. Otherwise,
yeah.
this still has a bid. It does not look weak. So even though we're coming up to the 250, the options market is still saying gung ho. So then what would you do in this situation? Because there are a lot of clients that their number one trade this year, for example, has been silver. I've got multiple clients who trade actively, some of size,
Yeah.
some regular, doesn't matter. Silver, advance, gold, advance, they have been their best trades. So now what do you do?
Yeah,
What do you recommend?
they've been excellent trades. They've been excellent trades. And I was just looking at the gold skew here. Very interesting. It's actually kind of flattened a little bit. So typically is a little bit steeper. As it's run up, people have maybe monetized some of that upside. And so they're pushing it down a little bit, which makes it interesting for just kind of, I mean, call spreads still look okay. The vol is, I wouldn't say it's outrageous. It's a little bit higher, but it's actually not that bad, generally speaking. Fairly low IV rank, according to this measure that I use. But gold itself isn't moving all that much. So it's expensive versus what gold's doing. So any way you look at it, it's not cheap. So you definitely, again, you want to use those structures, right? You want to use those like an upside call structure. If you really like it, you could own GLD here and you could use a 1x2. So you could turbocharge another move up to maybe, let's say you think it can get up to about 255 or so. So you could sort of turbocharge your play by buying GLD, and you got to believe in it. And then you pick up like a 250 at 380 and then sell like a 256. So what that does is you do two of those. We did this for a client on Tesla the other day, and it saved him 35 grand. This sort of upside, it's sort of almost replacing stock in a way. So instead of owning 2,000 shares, he reduced his position to 1,000, and we still created a similar amount of upside. And when Tesla kind of wet the bed, it saved him a whole bunch of money. So this is an interesting trade. You buy gold here, you buy a 250 call, you finance that call fully, almost just about by selling a 256, and that'll get your whole position out of gold at about 262-ish. So you'll get a pass from 247 to 262-ish, which is pretty good. That would be a very, very big move by November. Now, if it gets up there, then you lose your whole position. You'll do great. But if it sits anywhere in between 247 and 260, you're going to do great as well. So that's kind of playing the skew a little bit, even though that skew isn't massively, massively steep. That's one way to play it. I haven't looked at some of the longer term vols, but at this stage, maybe if you've done really, really well on it, you take some of your profits and you take maybe 30% of that and you just pick up some longer term options. There's nothing wrong with just kind of picking up some, you can buy a 250 for $14 out to June of next year. That's a lot of time for stuff to happen given the state of affairs in the world these days. Anything can happen. You could turn that 14 bucks into 30 bucks quite easily. If you look at the money right now, we're looking at 14. So if you could buy maybe like a 295 even, or 290. Now you're getting really, really aggressive on gold. So it's maybe not the best play out there, but I like the call spread.
Okay. So you wanted to go in and talk a little bit about hedges, maybe not gold on the upside as a hedge, which I think folks are playing it for all kinds of reasons relative to dollar devaluation and central banks, specifically China, settling outside of the USD and using commodities and gold and the like. We've got earnings season. So one thing you had mentioned also in your channel was you're looking at Netflix earnings and a QQQ hedge. Hit us up.
So looking at Netflix for earnings. So this is our QQQ trade. We'll save that. We've got Meta. Just so people don't think that we're only doing exotic structures and trying to impress everybody with all these multi-leg strategies. We're doing some simple stuff as well, right? So for people who just want to kind of stick to covered calls, I have clients who just really want to run a covered call type strategy on their underlying holdings. They have long-term holdings. They don't want to lose these stocks, but they want to generate some extra income. And so interestingly, I looked at something like Palo Alto. And so, for example, I bought this back here at around 320. And then it's kind of had the swoon down in August and it came all the way back. And now cybersecurity has really been back in vogue.
Wait a minute, how did you hold during that swoon?
Well, I just, I liked it as an alternative to CrowdStrike, and I really wanted exposure to a good cybersecurity name that has really good AI exposure as well. And I love this sector. I mean, it's a problem with no finish line, right? It's just cops and robbers chasing each other forever and ever. And for cybersecurity companies, that means endless revenue. As soon as somebody figures out, as soon as you figure out what the robbers are doing, then they'll figure something new out. So
and now China has quantum computers that can decrypt encrypted everything. Yeah,
exactly. The quantum names. Well, let's start watching those quantum names. I watched those a couple of years ago. I was a little early on that.
Back.
Yeah, they're back, and I think why not? And you know what, IBM.
Yes, I was just going to say the biggest one of all is IBM. Yeah. Oh my God.
Yeah, that's going to put them back on the map, I think. So what happened here is
it did. Look at their stock price.
It did. Yeah, it's had a great run. It's run $100 pretty fast. So this is a name that I really love. And so when you're doing the cover call thing, you want to make sure you understand the names that you really, really love. You have to be very careful. You don't want to get called away, and you want to make sure you have edge. So I wanted to show you this as an example of how I went about this. So I just owned it. I didn't really do anything until before earnings. I kind of sold out some really fat vol in here. It swung around. I scalped those calls for some decent money. And then it did this. It kind of consolidated and moved slightly down. And I thought, all right, this is a period where I don't want to get involved, partially because the volatility was very low. So in this period here, we had Palo Alto kind of move down over a few months. Vol was very, very low and not compelling. And so one of the things that I teach members and students is that, look, when you're not being given compelling edge, don't do it. Because when you sell a call, you're potentially giving up some of your upside. And the same goes for selling puts. If you're not getting enough for that, then you're giving somebody this ability to buy your stock after it plunges for way too cheap. So you want to always understand value and edge. And so I thought, well, there's no edge in this, so I'm not selling anything. And then it started to move up. It broke through this wedge here, I guess you'd call this. And is that a wedge?
What time frame are you on that picture? It's too small for me to
That's a
tell.
daily. This is Palo Alto. So
Oh, Palo
Palo
Alto on the
Alto
daily.
moving
Okay.
down.
Oh,
So it breaks out through here. And I'm saying, okay, this is what I've been waiting for. The reason we want to own good stocks in our long-term portfolios is because we want to give them a chance to do well for us. So don't get in the way. Now, what happened? We got back to this old level of earlier in the year in February. We reached this kind of 375, 380 level. There's my edge. In here, I have no edge. Why would I sell calls in here when it's pointing straight up and the sector's hot again? So I'm going to sit back and I'm going to wait for some edge. We get to this point. I hammered out some 390 calls for November 7th. I think I got about $7 for them. And now it's consolidating. That doesn't mean it isn't going to go up, but I was waiting for some edge, which was also bolstered by higher volatility. Back when it was in the 25th percentile, it didn't interest me. But now it's at 50. The stock's hitting upside resistance. That to me is enough edge for me to sell at some calls. So I just wanted to give people this example of don't sell calls, cover calls, if you don't have a good reason to. And if you're not getting paid many dollars for them, don't worry about it. If the stock goes down, whatever, you passed on $2, big deal. You missed out on a little bit of premium. Wait for that edge to be a little bit fatter in there. Okay.
so why did you use November 7th for Palo Alto calls at 390, which I understand the level of 390, just kind of real quick.
390, a little bit above where we are.
So same thing. This is your wedge on a daily, right? And we had the
Yeah.
same kind of review in the trading room, which was it was forming a Morningstar reversal off the 100-day. All it needed to do was get above, right? And
Yeah.
then stay above, a little shake and bake, and then follow through. We got a Bollinger Band expansion. We've got the 3-day. I know Archna was all over this. Namita, this was basically the price target up here, little trend line, but more importantly, your 380.84 exactly, which is the prior high in February, right?
Yeah.
So this is where you decide to sell some calls above it at 390. I get this, but why November 7th? Earnings aren't until 11:20. What are you trying to capture?
That's what I was trying to stay out of that earnings cycle, right? So I'm not a
Okay,
huge
okay,
fan of selling into earnings.
okay.
Generally speaking, things will outperform to the upside on balance. Now, that doesn't mean every single stock we trade is going to do that, but there are plenty of studies showing you just don't want to really sell into earnings. You want to wait and see where things settle. So that was my reason for it really,
Okay.
and then I'm getting that vol too, and so for a cover call seller, the environment these days actually is quite favorable. So, typically when you get a market, pushing all-time highs every day, you're going to get a VIX of 12, 13, 14, maybe. And that's not conducive to call selling. You're giving away, especially with that upside call skew, very, very probably inverted or very flat. You have all these covered call funds, which is what I used to do. I used to go in and smash out thousands of calls, and that would push down that upside. So we're being given a gift as covered call sellers right now. So for the viewers out there, if you're nervous about markets, well, guess what? You're actually being paid for your options, as compared to normal circumstances. So there is some positive aspect to vols being very, very high. As option sellers, we're just getting that little bit of extra juice, which is nice. So I like that part of it as well, getting some good juice, good levels.
And this is this speaking of skew and volatility, you posted this. I'm sharing it right now. It seemed fitting for what you were just discussing. What is this showing us? This SPX 3-month skew, 96th percentile as it relates to the index. Cheap or expensive? How are you using this in your trading structure of options?
So this is just really giving us an idea of how aggressive people are being to the downside. So this is really depicting skew, which is typically when we talk about skew, it usually is we're comparing the 25 delta put to the 25 delta call. Some compare it to the 10 delta call, depends how you look at things. So 3-month skew in the S&P is 96th percentile. That's very high. So what we've done is we've really gone from being very kind of panicky. So I'm going to switch over here, Samantha, and
Go
just
ahead.
show people. This is kind of gives you an idea of here we are. We're getting into the corporate buyback season. So I think that's kind
Oh
of
yeah,
interesting.
October 25th.
Yeah, that's going to be, that's going to be interesting. So basically you've got you have, it's kind of this old, well, when everyone's looking to the left, you look to the right. And so skew, it has been very, very sort of steep lately. We can see that on this chart here. So you tend to get, people are paying a lot more for out of the money puts. Why? Well, there are a number of reasons. One of them being markets crash down and not up, right? So people tend to want to pay up for that protection. And most managers are mandated to protect their portfolios. So we've gone from this period where, as you remember, Samantha, we were at extreme low, multi-year lows in the cost for 6-month and 3-month skew. Very, very, people had no interest whatsoever in buying downside protection. So what's happened, it's amazing. In just a few months' time, we've gone from people being very under-hedged and not caring at all about the potential for stocks to go down to being over-hedged. Now people are going bananas and over-hedging. And part of that is because of early August and early September. A lot of desks sort of had their heads handed to them. And a lot of risk managers sort of went, okay, no more of this not being protected stuff. You need to be protected. So people are preferring to stay long stocks, but with a lot of skew, with a lot of downside protection. And here's our gamma chart here. We like to talk about gamma a little bit. We sort of have this positive gamma up around where we are right now. And this could give us a little bit more fuel. So we talked about that corporate window. Maybe if we can push up into this 5,900, 5,950 level, this can act as an accelerant. So when you have a lack of positive gamma, and in fact, a tiny bit of negative, that almost acts as an air pocket. And of course, we have that magnetic force of 6,000 that can really get us there. And then we have the JPM collar, which funnily enough is we're almost there. We're almost, they just rolled that thing and we're almost at the call strike, which is incredible.
No, the call strike is 60-20.
60-20. Yeah. Okay. So we've got a little ways to go, but it won't be long. It won't be long.
That's assuming we get there, but it not always in a straight line. Are you seeing any volatility before we get there?
Yes. So that's what I think it starts to melt away. But what I think is interesting is that people are, of course, the October VIX has expired. So people are going to focus on November now. Now, while November looks past the election, because of this volatility echo that I'm talking about, this recency bias, people remember this event, these couple of events that happened, they're going to want to continue to probably hedge themselves. So I don't see the VIX really coming down as much as people think it might. I don't think we're heading to 15 anytime soon or 14, even though we typically do going into the holidays and everybody goes to sleep and it's time for eggnog. So, things relax. I think we could see maybe a bid stay in there on VIX. And so that's why when we're looking at hedges, so let's talk about a couple of hedges here.
Yep.
We could look at something like a VIX let's do the VIX first. So we talk about hedges in the community too, because we're all about grabbing income from options, but hey, let's do it in a smart way and let's think about downside. Always have one eye to the downside. And the VIX has been very reactive. We talked about this last week, how the beta of the VIX to S&P is off the charts. So we're getting that nice reaction because people are very nervous, like the cat in the room full of rocking chairs, right? So VIX is giving us that reaction we want. Sometimes you're better off in S&P downside protection, and VIX kind of happens to be an interesting, very reactive space. So you could put on something like an 18, 22, 24 broken butterfly. And it's going to give you this kind of structure. So you're going to pay about 75 cents for something like this. So it's important that you consider that as kind of lost money. You're not going to put 10% of your portfolio in something like this. It's a hedge. You might put 1% in. You keep it reasonable. But what it's going to do is it's going to play that reactiveness of the VIX to a continuation of people wanting to hold protection. And if we do move up into the kind of 22, 23 area again, you could very easily kind of double your money. And so I think that's a nice structure. Now, the nice thing about the broken wing is your typical fly is just going to kind of encompass a specific area. If the VIX really wants to go bananas, you're still going to make money all the way to VIX, whatever. So it's kind of a nice little hedge to have there.
All right, so that's your VIX hedge. What about a QQQ hedge?
Yeah, so the QQQ hedge, now the VIX hedge is really good. The QQQ hedge would be something like, it would look something like this. So you'd buy maybe like a downside butterfly at, I have it structured at the 485, 465, 445. So that's something you could put on for about $2.40. And it, as some of you may know out there, a butterfly isn't short a ton of delta. So I'll tell you right now, if you think a sell-off, you have to put yourself in one of two categories. If you think a sell-off is going to be very drastic and the floor is going to fall out of the market at some point, then you probably don't want the fly. It's something that needs to percolate. You need the market to go down and then sort of percolate at a certain level. And so if you look at the NASDAQ and you go, and I think it's very interesting that it's been a little bit weak lately. So maybe this isn't a bad place to have your hedge. Maybe we see another, not ASML, but another reason to get nervous about tech as the market broadens out and tech kind of gives back a little. Not, I mean, we know the market's not going to do well if the NASDAQ falls apart, but maybe this is where the vulnerability is. And so that could bring us down. I don't know where you would see it on the charts, Samantha, but that could bring us down maybe down in the 465, 464, 65 range below that 50-day. And that's where something like this butterfly could do well if we went down there and stayed down there. Now, if you think we're going to get down there and then flush and then come right back, I would go put spread because that's going to give you more delta.
What if we just have a melt up?
Well, if we have a melt up,
what happens to your hedge in this particular structure?
You're going to lose your 240. That's your cost. So you want to size appropriately for your portfolio. You could look at this as a hedge. You could look at it as alpha. I mean, if you're a trader and you're not trying to hedge a portfolio, you might say, okay, I like this. You could put on something like this in an Nvidia, right? You could say, well, if the shoe drops, Nvidia is going to be the general that goes down with that's going to be part of this big sell-off. You could put on a downside because a lot of the vols are pretty high, right? So the fly really works well in that high volatility regime. But to the upside, to your point, Samantha, the upside is actually interesting. Look at what we're seeing to the upside.
I'm still bullish. Like ASML did not shake me at all. Like I wrote about it at 1 o'clock, right after I close the trading room. I'm like, I don't see it mattering. I'm sorry, but I don't, like it's not going to move the needle right now. But nonetheless, we have to have hedges. We have to. So keep going.
That was a good call. That was a good call because the Nvidia came right back. And I was impressed. I have to say I was impressed with that. So the structure that we talked about last time is still looking fine, selling that downside to buy that cheaper upside. Well, we can see here, if we look at the flows quickly, I know this is a little bit foreign to some people, but over the next week, we don't have huge flows, but over the next month, we start to get a little bit of buying pressure from CTAs. So even though we know the CTAs are kind of 81st percentile.
I thought they were still in sell mode.
Yeah, I think things are going to kind of change a little bit. Plus, we get the corporate window and people are starting to get a little bit worried about the upside. And I'll tell you how they're expressing it is we've seen some big trades here. 100,000 of the SPY D615 calls bought for about 60 basis points of SPY spot. That's not bad. That's not cheap, right? That's part of this whole.
I saw that.
When everyone's looking left, look right a little bit. So people are starting to position themselves for the melt up again. They don't know.
It is something I see so evident with Nvidia. So I know I keep talking about it because it's such a leader of sentiment. It doesn't have anything to do with, believing the story. It has to do with the option flow. When we were looking at this, a few weeks ago, and I said, I still see 136. I know it's suffering sideways right now, 116, but I still see 136. As it went up to tag 136 just a few days ago, hundreds of thousands of contracts came in across a dozen different strikes in March. And it just puts a bid, psychological and otherwise, and they weren't even trying to hide, right? So it puts a bid in the market structure, but also a bid in the mindset that, oh, we can't short the market. Look at them coming in to the tune of tens of millions of dollars in directional calls, way out of the money, and they still were there the next day. So that's what I mean by Nvidia is making the market in many respects, and then these big SPY calls come in as well out of the money, and it's just this assumed Fed put, assumed election, what do you call it? Volatility crush. That's basically what the market is still reading to me. So
I think we get that crush. Yeah, I
yeah,
think
you
we
have
get
been
the
talking
crush,
to me about
Samantha.
that.
I agree. I think it'll happen. I think there's been this sort of, the event risk is going to fade, right? As humans, we're just, it's like the storms happen. People are still worried about buying supplies, heading to the hardware store. The storms happen, it's done. You know, you might have some repairs to do. And I think there have been some repairs, but the risk budgets have been expanded. And people are worried about the downside, but I think we can agree that the market's acting quite well. I don't know if there's anything particularly insidious going on behind the scenes. We don't know. I mean, August 5th was weird, early September was weird, so I always kind of have one little eye to the exit door.
Yeah, I can tell you that I am hating this market because it's a melt up. Not that because I'm a natural bear, but because I know how dangerous parabolas are. So in the same way we were looking at China, right? I had very specific levels on that Monday, the 23rd. I'm like, okay, so it looks like China's going to move into the 200-day. And then the next day they came out with a stimulus. And I'm like, oh my goodness, now I have to zoom out to my monthly and my weekly, and I've got to see where's that level. And this was a parabola in 2 weeks. So we talked about that. That was excellent trading. And then I'm like, okay, now it's hitting the wall. It must have fiscal. You have to have the story continue. With the story of our US stock market right now, I see no selling. So you're showing the quant positioning. We're looking at the option structure, for SPY hedges and VIX out of the mall, out of the money calls of size. But ultimately, I look for a breakdown in advanced decline. We don't have it. I look for a breakdown in breadth. We don't have it. I look for a breakdown in money flow. And I don't just look at NASDAQ, but I also look at NYSE, which is your composite, right? Many more many more players of small size versus the big concentration risk. And the market is whacked, man. It is just stupid because it's bullish with blinders on, which means that at some point, and I wrote about this, right? What are the chances of having a melt up? And I showed that particular chart last time, and I think we probably need to wrap this up pretty soon because we're way over. But the chart that I showed last time is the one that still has me of the opinion that we could still melt up. And humor me, but this is the VIX 3-month, right, ratio with VIX spot. And I said, if we come back down here, which I know for you, it threw you off because it's not a 0, but work with me. The 1 is a 0, okay? So whether it is my, doesn't matter. I've got 2 different ways that I look at this chart. If we are bouncing off and moving higher, this is bullish the market. If we break, it's not. So right now we're bouncing, and it's pretty easy to just go with the flow as long as this works. This is your August 5th reflexive bounce, way oversold, ridiculous. So that's what I mean by as long as this moves higher, we're still in the game with a bullish bent. ASML didn't negate that trigger, long story short.
Yeah, you can almost lop off that August 5th spike there, and we're really at the lows of that range. We're really kind of there. And I think people can agree. I mean, the market's moving at a 9 vol and the VIX is at 20. So something's off, but something has to correct, and stocks can't keep making highs and the VIX stay up there. So something's got to give. Worry levels, in my view, are probably going to come down, barring any, of course, we're always going to caveat that with barring any disaster or something going on with Iran and Israel. And I know that's convenient to be able to say, well, barring any disasters, but I'm sort of betting that we're not going to have the disaster, and that we probably the pain point is to the upside. And I don't know if this worries you here, Samantha. I know we're over time right now, but this, I love how you always look for the spark, right? There's always kind of the ability for markets to turn down sharply, but they need that spark. And then that's when all the gamma stuff that we talk about, that can be the accelerant, right? But you need that initial thing. Can this represent a problem? I know, you've got these revisions coming down, and I know analysts get things wrong all the time. In fact, most of the last few years, they've sort of revised lower and they were wrong, and then they have to revise up afterwards. Can this have some legs?
So that's not a timing tool though, right? So in fact, I did post this and talked about this Monday morning, how earnings estimates are falling, which if you think about it, that's not good. But at the other hand, it means the bar is very low for companies to report and beat. The other side of this is the confidence by CFOs right now. They're pretty confident on growth, on meeting their profit margins, but not meeting demand. So they haven't invested in the things that matter to growing the business in order to meet demand. They've actually invested in things like financialization and stock buybacks to meet shareholder demand. And hence the market has rewarded them, right, by stock appreciation. Not the same thing as actually meeting economic demands of consumers. So there is going to be that. But I think that the right now initial take is that earnings better delight because the bar is falling lower. But the bigger picture is, well, why? Right? It's because they pulled forward so much of that growth into this recent exuberance that we had. And we had policy intervention of size, which is to say Fed pause, Yellen Yahtzee from November 1st. Every single chart has a massively bullish engulfing candle from that date. And the market just went hot fire flames, right? Dollar and yields, they're suppressed. So as long as the Fed and Treasury can still game the rate market, and that is exactly what they're doing, then they're stimulating with lots of fiscal, and the can getting kicked. The market gamma levels are still now what we use, right, for supply and demand. It's not anymore price discovery of what bonds are really worth or what a company is really worth. So it's changed. Options now, and it was, I think Sam Carson said this yesterday in an interview. Because I used to say options are the flea on the tail of the dog. He says, nope, they're the dog now.
Yeah. Yeah.
So we're still really transfixed with the option flow. And until we get a macro trigger to interrupt the flow, the bullish flow, even the earnings warnings aren't upsetting the apple cart. Apple's still moving higher, Nvidia's still moving higher, and they will until we have a macro trigger, in my humble opinion.
Yeah. Okay, great.
Yeah.
Well, we covered a lot today. We didn't do the Netflix fly, downside fly. I'm going to throw that into the chat tomorrow in the Slack. So if you guys want to be a part of that, look into joining LaDuc. So we'll talk about a few of those earnings plays coming up. We have lots coming up, so there's going to be a lot of fun to be had.
Yeah, we definitely have a lot going on. LaDucTrading has 10 contributors, lots and lots of amazing value, live trading rooms, and Hans. And thank you so much for your expert review of how to protect and profit. I wish you all a great afternoon. Cheers.
Bye, guys.
Join Hans' options education course by scanning this QR code or by clicking on the link in the description. Subscribe to LaDuc Trading YouTube channel for more macro to micro options power hour and other content.